This is MacroVoices with Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Now let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Darius's picture that says Looking for the Downloads. All right, Nick, let's get to some of these charts. On page 2, we have the S&P 500. I'm curious at what levels you're watching here.
Yeah, so looking at the S&P here, spot right now is about 3880 or so. For the January 20th OPEX, plus minus 140 points on the expected move. The upside there is 4,000, which is also a key level of resistance. The downside there is 3,700, which also happens to be a key level of support, with 3,500 being the next level of heavy support back from the October lows. What are you thinking on these markets here, Eric?
I don't have any strong conviction short term. As far as medium to long term, I do not think that the final low is in for the bear market, and I still think that less than 3,000 on the S&P is very possible before this is over. But before that happens, I really have no strong conviction as to what happens in the short term.
Interesting perspectives. Like for me, when I look at that S&P 500, I think we're actually at a very critical pivot. This 3,800 that was the lows throughout the holiday season, to me, line up with a perfect fib zone. And essentially, we have a really important decision that the markets are going to make on the jobs numbers and next week's inflation numbers is, will we be breaking those 3,800 lows? The way I look at it is you can almost use it as a pivot where the market has the upside still open for another push to retest its December high if 3,800 holds. But if for whatever reason the news is interpreted bearishly and starts a sell cycle below 3,800, we go right down to that level that you mentioned there, Nick, which was down near the 3,500 lows. But the interesting thing to me, though, is that that was where the NASDAQ is trading. So let's move on here to the Qs. And Nick, like one of the things I'm looking at here is that if the S&P breaks 3,800, that would almost certainly push the NASDAQ to a lower low. And that could in itself start a feedback loop of selling that creates some liquidity. What levels are you watching on the Qs?
Yeah, all valid points there. For me, I'm looking at different levels. The upside here, so again, looking at the January 20th OPEX, does not factor in earnings at all. Keep in mind, earnings will start late January for big tech especially. So I think Apple reports the week of the 27th, I believe. But right now for the Qs, the spot is 366, plus minus 13 points by January 20th on the expected moves. The upside here is 280, which is also a key level of resistance. The downside here is 253, which is just below that October low of 254. Now, again, we're seeing a lot of negative sentiment in the tech sector right now. Yesterday, Amazon laid off 1% of their workforce, and Salesforce laid off 10% of their workforce. So we're seeing a lot of layoffs here, which could also boost EPS in the short term as expenses go down, obviously. But again, we have late January, early February earnings coming out very soon, and that will dictate where we go in the short term. Keep in mind, we have the pre-COVID 2020 highs of 236, which are the next key levels of support if we break below 250 on the Qs.
All right, so moving on to page 4, we have the VIX. And what I'm actually surprised, well, I'm not totally surprised, Nick, that the VIX stayed relatively low, pricing in that kind of trade range price action of the holiday season. But here we are in January, and certainly the market is poised in the first quarter to have some volatility. So watching the VIX for signals, I think, is really important. For me anyway, that 25 level is a very important pivot, because if we, for instance, had, like we were saying, the NASDAQ break to a lower low, S&P break below 3,800, and at the same time the VIX is spiking north of 25, to me that is demonstrating that the market is in some sort of a bigger sell cycle. Do you see it the same way, or what levels are you watching on the VIX?
Again, As I said in the past, the key levels I'm watching at the 20 level and the 25 level. If you get below 20, obviously lower volatility. 25 is a key level I'm looking at, where if we break above that, we'd see a lot more volatility and a possible spike to 35 or so. But again, to me, isn't that surprising that we're seeing the VIX kind of stay in this lower range? Because if you look at the past 2 weeks of price action on the S&P, we've seen a very, very narrow range on the S&P. Since basically December 16th, we've sat between 38.90 on the upside, and on the downside, 37.64. So about 130, 140 point range roughly. And we've just bobbed around in that area for the past 2 weeks. So not surprising at all, the VIX hasn't really elevated too much. But again, I'm watching the put to call interest right now, which is 0.44, and nothing really crazy there that I'm seeing. But I do want to look at the 25 level. If it does break that, I do expect a push to 30 or 35, and that could coincide with CPI or the next FOMC or also the next earnings season. Now, moving on to the US dollar on page 5, Eric, has anything changed in your thinking?
The downsloping short-term channel has now been broken, so to my eye, this is now a sideways consolidation as opposed to a downtrend. But I have no strong view as to what comes next in the short to medium term. Longer term, I found Zoltan Pozer's year-end piece anticipating serious efforts from both Russia and China to end dollar hegemony fascinating. So was that peak that we just saw at 116 on the Dixie a few months ago, was that the final peak before the Luke Gromen moment where the dollar, finally loses its hegemony over the global economy and goes into permanent decline? Or do we still have higher to go on the dollar, as Darius suggested in today's feature interview? Jury's still out in my mind, but I highly recommend Zoltan's year-end piece for listeners because the insights that it contained around what the ramifications of a multipolar geopolitical landscape will be on the dollar longer term, I found to be absolutely fascinating.
And my views on the dollar are somewhat on a bullish tilt, which is I don't see that much more further short-term downside on the dollar. Like we've already seen a 2,000 pip drop in the U.S. dollar yen and some pretty extraordinary bounces back in the euro. At this stage, I don't see those trends continuing in a big way. Obviously, there's always room for a couple hundred pip moves, but I think the next big move is actually a U.S. dollar rebound. And what to me, if the dollar was to start rallying, it would probably be an environment where the bigger macro story is risk off, and it'll be really interesting to see whether the inner markets all line up that way. Now, moving on to page 6, I just wanted to quickly touch on crude oil. I know, Eric, you had a pretty extensive breakdown of your views, and really it's showing that big 10% drop in 2 days that we saw in crude. But what was, to me, was important was the fact that we have not yet seen legitimate bullish price action in oil. Now, while on the bigger picture I remain somewhat optimistic in bullish oil, there clearly is no sign technically that a new accumulation cycle has begun. We continue to see this pattern of lower highs and lower lows, and every short-term bounce is immediately met with new rounds of selling. This time around, what will be really interesting to see is whether or not the previous low around 70-72 holds and starts establishing a base, or whether we have another full leg lower, which could measure easily down towards $65 down on crude. And so I'll be watching closely whether these support lines hold, but nothing really bullish to say here on crude.
Let's move on to gold on page 7. Eric, what are your thoughts on this breakout?
It's hard not to love gold here, but caution is warranted just in the sense that the upper trend line resistance in place since early November has been tested and rejected 5 times now. That resistance level is currently 1877, but the number goes up every day. My point is simply not to chase it right at the top of the channel, right along that trend line. There's no clear parallel trendline support, but the 21-day moving average has been the best indicator of support that I see on the chart, and it's currently down at 1815. So I'd wait for a dip before putting new money to work on the long side of gold here, but overall the uptrend seems to be intact, and it seems to be progressing nicely. We had been in a sideways consolidation towards the end of last year. I was wondering if it was maybe about to roll over. Looks like we're seeing the upside resolution to that consolidation, so let's see if it holds.
Eric, I totally get your views on gold, but for me, I actually, on the short term, think that this gold move is more or less run out its course. I don't see, at least in my initial approach here, that we're going to make a big breakout yet to the previous highs. To me, this was a very oversold market, and as the dollar index did its correction, it alleviated the pressure on gold and allowed it to, like a cross currency, to have a mean reverting rally. The big thing for me here is I'll be watching whether or not some sort of a correction in gold starts to happen below 1900. I don't think that gold is necessarily going to go all the way back to its previous lows, but on the short term, I anticipate that gold is going to probably put in a short-term swing high. I don't think that changes a big picture view of how investors should be positioned on gold, but it's certainly, I think, not a tactical moment to be chasing gold higher here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.